Good evening, everyone. Welcome to tonight's live stream. My name is David Matney with Nebraska Realty, and we got a great show for us tonight. I have a lender that's coming on board. We're going to kind of talk about the pre-approval process and that sort of thing. So, I'd like to introduce to you Alana Hallaert with Guild Mortgage. So let's bring Alana on board. Hey, Alana, how you doing?
Good. I'm doing good on this very hot day.
It is. And I'm glad I kind of stayed inside all day.
I had to go in and out, but I was glad to run from AC to AC to AC. So I was okay.
Exactly. All right. Well, hey, we got somebody who knows all about heat, and that would be from the South. We got Clark on board. Hey, Clark, how you doing, buddy? All right. Hey, Clark, thank you very much. Hey, and we got James. James, all right. Thanks, James, for stopping by. Terrific. All right. Awesome. Well, guys, thanks for stopping by. And all right, we got Ben. Ben is here. Ben, hot and so not happy. All right. All right. Okay. Hey, and we have Nick Drake is on board. All right, from Las Vegas. Well, thanks a lot, guys, for stopping by, and we'll appreciate everybody's chiming in on the chat. All right, Alana, thanks for coming on board tonight. And if you don't mind, kind of tell us a little bit about yourself and a little bit about Guild Mortgage and that sort of thing.
Well, I've been in lending since 1993.
Wow.
I've been a loan officer since 2003.
Wow.
And I love it. It's constantly changing
It sure
and
is.
evolving with everything that's going on in the industry and the housing.
Right.
But on top of that, I am married 35 years.
Wow. Congratulations.
Thank you. 2 beautiful grown children and a brand new grandson who's 8 months yesterday. So
oh boy,
my life is filling out.
Yeah, that's fun
and evolving.
I don't have grandkids, but I mean, I'm sure it would be fun. But I'm like,
all in good time, right?
Exactly. So, now, yeah, 2003. That's a long time. What would you say would be the biggest change that you have seen in the years of doing it? What?
That's a great question. I think I would have to say we've gone through sellers markets, buyers markets. They rotate, they transition a lot.
Right.
I think that those markets have started to become longer in their duration before we get to the next market.
Yep.
I think that our borrowers and buyers are changing because technology has come into play, and it can be a very good friend to us when it works well.
Right.
I think technology has allowed us to have a lot of flexibility that way back in the day, we had to meet you.
Right.
We had to meet you multiple times. You had to bring paper. There was no way to track our information without having folders that were this thick.
Right. Yeah.
Now we're paperless. We don't have any of that.
Right.
So I think technology is probably that biggest change. I think the need of people to want to buy a home has never changed, but the manner in which we get them to the finish line is probably evolving.
Gotcha. No, that's a good point there. Hey, and we got MH08 right around 80 in Denver today, looking at
so we're jealous.
Soon rains tomorrow. I'm going to try to get the gutters cleaned out after the stream. We don't want to come between anybody and their gutters because that's important. You got to have that's the holy trinity of a dry basement: gutters, downspouts, and grading. So yeah, that's important. But hey, MH08, thanks for stopping by the stream. Let me ask you this: what would you say? Pre-approved versus pre-qualified. Can you explain the the difference for folks between getting a pre-approval and getting pre-qualified?
Absolutely. So think of pre-qualified as quick, fast. We don't have a lot of time. We haven't had the ability to verify anything, and we take the information we get from our buyers as gospel until we verify it.
Right.
And sometimes then we have to tweak incomes and assets and things of like that. But a pre-qual is going to be your quick version.
Okay.
And our pre-approval is going to be a very strong, vetted approval.
Gotcha.
We've checked employment, we've checked income, we know where your assets are coming from, and we've got that all kind of wrapped up in a tight little ball, and we're ready to go. I would say when we present offers through our agents, they really, really like knowing someone is pre-approved versus the pre-qual. But when we don't have the luxury of time and we're out there showing to somebody and they're like, this is it. This is the one. I want to do it today, right now. That's when we do the quick version, and they're okay. I mean, we dig and we look and make sure that we're doing that pre-qual as best we can.
But it just doesn't give that warm and fuzzy to a listing agent to presenting that offer as a
not as much as the approval.
Oh
approval is no, unless something dire happens, it's a finish line type situation.
Okay. Now, in terms of documentation for folks that are looking to get pre-approved, in terms of lining up their documentation, what documentation do they need to have?
It's another great question. Let's talk a vanilla in the sandbox approval.
Okay.
Someone that's W-2'd hourly, just a very plain type situation. You're going to do 30 days of pay stubs.
Okay.
Most recent ones, not last year's. We want most recent ones. We're going to look for 2 years of W-2s, sometimes 2 years of tax returns, and 60 days worth of bank statements, or wherever your money is coming from. Or, wherever that asset is going to be. If that's a retirement account or something like that, then, we can do quarterly statements. So that would be the most generic form. Okay. But as we move into needing to qualify somebody that gets bonus pay, commission, overtime, those each have different criteria for how long you have to be able to document that. And each one of those is dependent upon the rest and the strength of a customer's file. But typically it's somewhere from the 1 to 2 year time range, kind of leaning on that 2 year time range. So there's a historical, component to it. So we can see that they've earned it over that period of time. And then we would want to maybe ask for a little more information. But W-2s, tax returns, pay stubs, those are the holy grail of what everybody needs to get started. If we would work with someone that might be self-employed, and depending on how long they've been in business, do they have business and personal returns or just personal returns? There's different kinds. And those could be anywhere from 2 years to even 3 years if we're trying to document historical information, like if they ebb and flow. Was 1 year a great year and 1 year not so good, but then another year was really great. So we can kind of see a trend. But those would be the basics to help us get started, and we would modify as we go if there was something unique about our customer.
Yep. Okay. And Ben says here, let's hope the rates are coming down soon. So
you and millions of others for sure. They're going to talk about that tomorrow, but we don't anticipate anything tomorrow. But we might see something later this fall, or onward into winter and spring. I would love to tell you we get back to 2s and 3s, but that's probably not sustainable to keep the lights on anymore.
Right.
But we'd sure like to see some 5s. So
That would be
that'd be awesome.
great. Yeah, that
Mhm.
would be outstanding. Yeah, no, that's let's see here. And we got another comment here. It says James says, with construction being more expensive due to tariffs, will lenders be lending more or less? What's your thought process
That's
on
a
that?
good question. I think it's yet to be determined
Yeah.
on tariffs. When we talk about tariffs, are we talking about unique imports? I mean,
Mhm.
we've got lumber, we've got metal, we've got
Right.
resources here, which wouldn't necessarily cause a lot of increase, but
Mhm.
because we'd be depleting those supplies and maybe having to bring it in from other sources, that
Right.
could have an effect. I think from a construction standpoint, even with, labor, we got to find people in the trades to,
Right.
be a part of the process. And that's a very, very challenging component right now to find people that are in the trades or quality
Right.
ones, good ones that,
Yeah.
that know what they're doing. I'm sure contractors are just trying to figure out how to fill those gaps, and we
Right.
need those new houses. So
Yeah. No, that's
I think that's a really tough question. It's a great question, but I don't know that we've played it out quite yet.
yeah. Do you think
No.
there's folks that are like with sales being down as they are, do you think there's a lot of folks? I mean, obviously, affordability is a challenge just because
Mhm.
rates are where they're at.
Sure.
Um, do you think, as far as if there are folks that are sitting on the sidelines now? Are you meeting folks that are like, well, I'm going to have a kind of a wait and see attitude right now? Is that what you're running into on your end?
Well, we see it from two faces. We
Okay.
see it from the folks that have those 2s and 3s that we
Hmm.
refinanced during COVID,
Right.
which helped millions of people. So, I mean, that was a good thing,
Yeah.
but it's evolved into, okay, I really don't want to sell my house, even though I don't maybe need this particular one anymore.
Hmm.
It doesn't suit my needs, but I've got a 3 or even a 4.
Right.
And now I'm going to go turn around and have to pay 6 or, 6.5
Right.
to get a new home. Some of those people are waiting and watching. I think if we could get into the 5s, it would
I
motivate some
think
of those
so too.
people.
I think that
I
would
think
bring
it
a
would
lot of
free up.
folks.
We need the inventory badly.
Right.
So if we could find a way to get there, I think that would promote business. I also see the other side of the sidelines going, well, I think they're going to come down at some point, so I'll just wait.
Right.
Unfortunately, while we're waiting, they can go up. The
Yeah.
cost of the
Yeah.
house,
Right.
whether new construction or existing,
Right.
they're going to go up because their demand is still great. So
Yeah.
while you're waiting for rates to go down,
Hmm.
you end up paying more because the cost of the home can go up.
Right.
Um, so my conversations kind of play towards that. So
Hmm.
you can have somewhat of your own educated decision making on which one feels best, because you got to be
Right.
comfortable.
Yep, exactly. Now, how long does the pre-approval process typically take? Once you got all your documentation,
Mhm.
everybody's loaded up and everything, how
Yep.
long will that take?
I'm going to answer that with prequels, same day,
Okay.
couple hours at most. Generally, we can get those hammered out quickly so that we
Mhm.
can at least get our offer in.
Okay.
If we're gathering information, you've done an application, I'd say just a couple of days to
Okay.
get the verification process, because we're relying on outside sources to do that.
Right. Okay.
Um, I think we would probably see that.
Mhm.
Sorry, I got a tickle.
All right. And
Um,
then Clark has a question here. Do we have any suggestions for people that might want to use their own outside lender to purchase a new construction, but also be able to get their incentives? And that's something that we run up against because there's several
mhm,
local builders that I'm aware of that, like, hey, kind of sweeten the pot a little bit.
They do.
And they want to have more control of that process. And I understand that,
Absolutely. Because they're familiar with that lender and their
exactly. Yep.
I would say that from my world, my company, we've had very long, in-depth conversations on if I have someone that I have pre-approved and they've decided to build, and that builder does have a preferred lender, from a guild, and I can only speak from mine, from a guild standpoint, we're going to compete with that.
Gotcha.
Because we feel like we have a connection with the customer and we want to make sure we continue to the finish line with them.
Gotcha.
So depending on what those incentives are, we're going to try to, compete with that one-on-one and make sure our builder knows that, we've been around for 65 years. We're grounded. We know what we're doing. We have a lot of new construction background so that we can help through the process and keep the buyers, to have low anxiety on building and things like that. So I personally think that if you are connected with a lender who may not be the preferred lender, have the conversation up front. What can you do for us if we decide to go this route? So they can approach their lenders, their builders agents with that same information.
Gotcha. Okay. Now, how long, once they're pre-approved, how long is that valid for?
Great question. As long as the credit report is valid, and they're usually good for 120 days.
Okay.
So unless we have a job change, we incur additional debt, or something unforeseen would happen, 120 days. And if we're running out of time, we'll pull another credit report at the end to make sure that we have enough time. And honestly, that does happen where those expire and we have to drop in a new credit report because it takes a while to find a home right now.
Yep. Now, what about things like, talk about a little bit about, when people, sometimes they have the great intentions, like they're going to move money around, or they're going to, sell their motorcycle and put that into their account. Talk a little bit about how that can really throw a monkey wrench into things if they,
the do's and don'ts is
kind of like that. Okay.
Everything that you do, think stability.
Okay.
Keep it stable. Take us through the 30 to 45 or 60 days to get you to closing. And then if you decide you wanted to go and do some things after that, it's irrelevant to us getting you approved. We beg you not to change jobs.
Yes.
We have had some horror stories where people have unfortunately been let go, or laid off, unbeknownst to them until last minute. And then we need to kind of scramble a little bit. But if it's intentional, make it intentional after we get done, because that can cause you a delay, perhaps, in closing. Don't make big purchases. No cars, boats, trucks.
Yeah.
Shopping at furniture stores.
Don't
We don't want to cause any troubles there, but a lot of people get excited. This is an emotional situation where we're buying something new. We want to go out and pick out nice furniture, appliances, things of that nature. We need to keep that as minimal as we can. If you are someone that maybe your file has higher debt to income already, these things can cause us to pull back on the approval. We've actually had that happen. So we don't want to see that. And we try and be upfront with folks and tell them, please don't do that. Now, things out of your control, what can you do? If your car breaks down, you got to go to work. You get laid off and you finding another position, we figure it out. But in anything intentional, we would prefer you wait on those.
Okay. And that's even including within your company, promotion and things like that. That can throw a monkey wrench in it too, as well, couldn't it?
Say that again.
If somebody gets promoted within their job,
Could.
depending on how their income is,
Yep. So if
that can,
you're a hourly or salaried W-2 employee and all of a sudden you get a wonderful promotion and now you're going to be a salary plus commission,
right.
you don't have any history of making that commission.
Yep.
And that may cause challenges with being able to use it.
Okay.
Now, there are exceptions to the rule.
Okay.
Where maybe you're taking over a territory
Mhm.
that has been tried and true track record that we can see. I mean, there's so many different variables that we could look at, but we don't want you not to take a
Right.
nice promotion, but it would be something we would want to talk about and make sure we're fully aware of, so it doesn't bite us at the end.
And that's something that's really important for folks, and that is to have that communication with your lender. It's a team effort.
Yep.
Before you do anything, talk to your lender and just run it by them, saying, "Hey, I'm thinking about doing this, or should I do this?" That sort of thing before you do anything, because that will jam things up. Okay.
You had
And
mentioned selling a motorcycle or something like that
yeah,
for assets. Those are things we need to talk with you about.
right.
It's simple on your side to say, I'm going to do that.
Mm-hmm.
But there's a documentation process that we want to make as painless as we can.
Mm-hmm.
And sometimes if they're done without us knowing it, and then
Yep.
we document a $5,000 deposit in
Right.
your asset account, we're going to be like, okay, now we got to know where you got that.
Yep. This is a great question here. Clark says, how long do you lock a rate for?
It's a great question. So once you're under contract,
Mhm.
you're going to typically, as long as it's not new construction,
Okay.
you're going to know how long you need the lock for.
Mhm.
So for example, if I'm closing in August,
Mhm.
and I just wrote one today, well, I'm going to need to see, do I need 30 days or do I need
Okay.
more than that? If I need more than that, maybe I wait and watch rates. Maybe I lock it for 45 days. Excuse me.
Oh.
So if you're new construction, you need to have a really open conversation with the builder
Yeah.
to find out what that timeline is.
Right.
Sorry.
Oh, need some water?
I do, actually. I do. I'm asking for water. So with new construction, if you bought a spec, you might have an idea when that's going to go ahead and be finished. If it's a build from ground up, maybe it's 6 to 8 months or even longer. So what you need to do is definitely, if it's a builder, you got to know what they're doing and what the timeline is. And even then, there can be delays that are unforeseen.
Oh, yeah.
With something that's coming in. If you're working with a lender on an existing home, once you're under contract, you're very, very likely to know exactly when you need the lock to be good through. We try very hard not to have to do extensions because they can be expensive, especially if rates have moved for the worse.
Gotcha. Okay.
And if they're getting better and better,
Okay.
well, they'll do an extension for you because you can't get that better rate once you're locked in. It's basically done. But if you're trying to watch the market, you got to have really good communication with your loan officer. This is my water.
That's service right there. I was gonna say we can go on a break.
No, I got it. Thank you.
And I think it's, I mean, in terms of, you can't officially lock until you have a contract. Is that right? Or
there's a few programs out there, specialized programs. We have
okay.
At Guild, we have one called Lock and Shop.
Okay.
So you lock the rate, but then you've got to find a property. You've got to be under contract, and you have to close within that time frame.
Gotcha.
I'm not sure that I would suggest doing that. I think it adds a lot of pressure.
That's a lot of pressure there.
Especially when we don't have the volume of inventory to just pick from.
Okay.
But I would say normally you can't lock what you don't know.
Okay.
You need to know your property, you need to know the price, and you need to know how long you need it for. And those
Okay.
are the critical components of the platform.
Gotcha. Okay. And Clark has another question here. How much percentage wise does a lender typically calculate in when looking at student loan that might be in deferment or forbearance? That's a great question.
1%.
How much?
1% generally, if you're doing Fannie Mae,
Okay.
FHA. If you're doing Freddie, we can do a 0.5%. This is if there is no payment on a credit report and we can't document anything, which is
Okay.
generally what happens when we're in deferment and forbearance, because there isn't anything being calculated out there on the credit report for us to see, just a balance. So 1% is very customary, a 0.5% for Freddie, depending on the loan we're doing. And VA is even more different. They take, now I have to think, they take 5% and divide it by 12.
Gotcha.
So
Okay.
we get a percentage of that, but it's less.
Okay.
It just depends on, which program you're using. Does that help you, Clark? Does that answer your question?
Let's see if he's
Okay.
this here. Now, let's see. James has a question here. As a lender, do you seek the best rates with banks or mortgage companies for your client, or does your company use a specific bank or mortgage company? That's a great question.
So for my company, we have 2 sets, and David and I were just talking about this yesterday. We have 2 sets of rates that I'm going to look at. One is where we keep the servicing, and I'm going to look at those rates and I'm going to see what those are. As a lender, we're a mortgage banker. As a lender in that capacity, we also have a huge servicing platform.
Gotcha.
So I like to keep my loans so that I can always be watching and helping you if you have a question.
Right.
I look at those rates first.
Okay.
We call those retained. Service released is going to be all my investors, New Res, PennyMac, places like that. We're going to look at AmeriHome. We're going to look at them and we're going to see what their rates are. And I always go with me personally. I can only speak for myself.
Okay.
I always go with whatever gets the best pricing for my customer. Whether it stays with me or it doesn't is irrelevant to what I want to make sure they get.
Gotcha.
But that is us. If you're working with a broker, a mortgage broker, they're different. They're going to be kind of that middle person who's shopping for you from investors. If it's a credit union or a local bank, they may have an entirely different rate system that they use. Most don't service their loans, so they're looking for outside sources.
Gotcha.
It's very expensive for places to portfolio the loans. That means they retain them. And you need to be pretty good size to be able to afford to do that for their clients. Does that help?
Yeah, that makes a lot of sense. Now, for folks that get denied, they go to get pre-approved or for whatever reason they get denied. Do you see kind of like a common denominator in terms of what do they see? Is it credit score or is it too much debt or is it debt to income ratio? What do you see as the biggest denial for folks in terms of commonality among people that are?
It's a tough one. We call that future pipeline.
Okay.
We are going to help try to guide them into being able to purchase at another time.
Yeah.
We tell them that the timing is off right now, but here's a game plan. And we've had people that have worked with us for a couple of years do what they need to do, and come back, and here we are.
Okay.
So it depends on the dedication of the customer, how much they want to be involved in that.
Okay.
I would say the two biggies
Mm-hmm.
are going to be credit.
Okay.
So payment history, whether that's slow pay,
Mm-hmm.
a pattern of derogatory pay, which means something happening more than once over
Okay.
a short period of time.
Yeah.
And the other one's going to be the debt to income load.
Okay.
So there's a variety of reasons for each of those. Sometimes we can help people that have had some bruising up of their credit scores.
Mm-hmm.
But if it's a true denial, we tell them, okay, here's what I think would happen if we did this or we did that. And it isn't always, I should say, it's not always slow pay or derogatory information. Sometimes your credit score can absolutely tank because you have taken a revolving debt and taken it to the limit and left it there. So you have a $500 limit, you owe $495 on it. That is really going to hurt credit scores. And so those kinds of things can actually be fast-tracked to be done quickly by bringing balances down. And we can see that, and we can figure out what we get for paying them down and help them with that.
Gotcha. Okay. And then what about, can you kind of talk a little bit about debt to income? Kind of explain that to folks, because I know that term gets thrown around a lot.
Yep.
Can you kind of explain that? I know it'd be nice to have a whiteboard or something where you can kind of pencil it out and everything, but if you can kind of explain it to folks just so they can understand that.
So debt to income, short term, it's called DTI.
Okay.
We refer to it as DTI. So debt to income is simply your debts versus your income. And there's two pieces to it. There's a housing ratio, which means your income versus your housing expense needs to be within a certain parameter.
Okay.
Then you have a second, we call it the back end ratio. That's housing and all your existing debts. Student loans, car loans, credit cards, installment loans of some kind. Any of that is going to go into the back end.
Gotcha.
So again, there's a box that it sits in. Sometimes we can push the box sides out and make things work and go a little bit higher on those ratios. And sometimes they're steadfast. We can't manipulate them to be any more than what the industry allows for.
Okay.
When we find a situation where maybe that box is tight and we can't get what we need, we'll look at another program, maybe an FHA program, which allows for higher ratios, both in housing and back end. And that's a matter for us to look at and talk to the customer about, depending upon their situation.
Okay. What about a situation to where you have a couple, let's say it's a husband and their spouse, and one of them has really bad credit and one of them's credit is fine, but the income wise, how does that work can you use both their incomes? How do you navigate a situation like that? Because I know that comes up quite often to where it's like somebody's on the loan or there'll be a couple on title, but it'll only be one person on loan. Can you kind of explain that a little bit?
You bet. So when those situations come up, we usually get a joint application, and we can very clearly see when someone on either side has some struggles or things that we need to deal with. Then the conversation turns to, okay, do I have enough income maybe to just have one spouse on there? And when I take off the other spouse that has maybe the poorer credit, because with them goes their income and their debts.
Okay.
And sometimes that leaves very little debt for the other spouse maybe.
Okay.
Or maybe it's something we can pay off to get them and stretch them skinny enough to cover the new house payment.
Gotcha. Okay.
It's like a puzzle.
Okay.
So we're constantly moving pieces and parts to see what we can do about making it a real cohesive package.
Right.
And sometimes that means we have to run solo with a person, whether they're married or joint or whatever.
Right.
Sometimes they'll come in and they'll be solo, and we need to look at maybe having a co-signer, someone
Gotcha.
that can add income to help us get over the hurdle of whatever it is that we're challenged with.
Right.
Does that help answer that question?
It does. And I think it's important. You bring up another point about co-signing. And a lot of people co-sign and they don't know they're not aware that that affects their debt to income ratio. So you got to, if
Absolutely.
you're going to buy a house,
Mm-hmm.
you better be careful about co-signing with anybody, because that's going to be a
Debt.
ding on your credit.
Absolutely.
So
You have to, as a co-signer, you have to know your obligation is to be the backup plan if borrower A, who you're signing for, doesn't make a payment.
Right.
They're coming back to you because you're signing for the support of the payment. If for any reason borrower A skips that payment, it's coming against your credit because you're both together on the note, on the loan. So let's say you're going to buy a house in a year. Well, you already have a house payment on there. So can your income support the one that you want plus the one you're signed on? So you have to think about those future things as well.
Okay. MH08 says, what's the smallest mortgage I can get? Let's say I sell my house for $200,000 and want to buy a place for $150,000 and have cash on the side. Okay.
So typically speaking, larger industry lenders are going to have some type of cutoff.
Okay.
Maybe 50,000, 75,000. For us, it's 50.
Okay.
If you're going less than that, it's much more economical for you to look at a local bank, simply because they're probably going to have some other type of loan that they can do and hold in house for you, maybe a HELOC or something like that, where the fees aren't going to be so heavy and maybe even the rates would be better. You get down below that range and it gets pretty expensive for a person to have a traditional type loan.
Well, because you look at all the closing costs that are involved, and you're talking maybe only a $50,000 loan. That's a substantial amount of that 50 grand. Yeah, that's.
And I have partners that I work with here locally, that are bank partners that I will ask to help somebody that I think is going to be. It's just too expensive. I'm more of a penny pincher than you would think. I look at every little dollar, and when it gets to a certain point where I think the economics of it makes sense to go someplace else, then we're going to have that conversation, and I'm going to give you a reference to somewhere that I would go if I was in that situation.
Excellent. Sorry about that. My phone went off.
Okay.
All right. Clark says, if you have a lower to no debt and a healthy credit score, could this help you get a lower interest rate? That's a great question.
That's another really great question.
Clark, thanks, Clark.
How do I say this? You're going to get the best of the best of the best when you get to a certain point, and anything higher than that, I don't want to use the word irrelevant, but I'm going to say you get to a certain level, and let's say you're a 750, 760 credit score, very low debt to income ratio, buying something below, $1 million, let's say. You're going to get the same thing that a 780 credit score, no debt, is going to get. It's when you get below that,
Mm-hmm.
and I'm just using 750 as a guide. I mean,
Yeah.
it could be 700. When you get to a certain level, there are additional pricing that is going to be involved from different investors, because they're going to base everything that they do, fees and rates, on risk.
Okay.
So the risk assessment, when you get to somebody who's got little to no debt and credit scores of a certain level, they know everybody above that is in the same cream of the crop bucket. Okay. You're going to all get the same level of pricing. But
Gotcha.
as you come down the ladder, the risk assessment changes. And when you get into the low sixes, 640, 620, 600, 580, now your risk level is completely different. And we're at the mercy of maybe only having one or two options. Gotcha. Where up here, you guys have all sorts of options of places that we can go to look at rates and fees. Does that help? I mean, it's not really an answer that tells you get the best of the best, but you get to a certain level and there just isn't anything better to get.
Okay. Gotcha. Yep. Okay. And then MOH said, yep. Okay, cool.
It's all about risk.
What are the most common loan programs that you see
There's 4.
Okay.
Conventional, FHA, Federal Housing Authority, VA, Veterans Administration, and USDA. So there's 4 of them. Within every one of those, think of them like umbrellas.
Okay.
In every one of those, you're going to have all sorts of different programs and options within them. Okay. So, for example, VA, you might have 100% financing. You could have 5% down, 10% down. You could have subsequent use of your VA. You could have first-time homeowner programs that partner with VA. Okay. FHA, they're the government. They're going to be, they're going to have a bigger sandbox to play in because they support maybe a little bit higher debt to income ratios. Their credit scores could be a little bit lower. So their risk tolerance is much greater. So think of them in a big sandbox that we can kind of push the sides on depending on what we want. And they have lots of different programs within them depending on what you need, what your need is. Conventional, smaller sandbox. Private, their risk tolerance, not so great. You can push their limits a tiny little bit, but where you could push FHA or even VA over here big, these guys are going to be like, nope, we don't like that. Gotcha. So USDA, they are government funded, but they are for smaller locales. So something, I'd have to look it up, but I think it's like under 20,000 population or maybe 30,000.
Yeah, I thought that. I've heard that number too, somewhere 20,000.
We have a USDA has a website that you can plug an address, a specific address into, and it will tell you if it qualifies for USDA. USDA doesn't have a lot of flexibility, but they are a conventional loan that allows for 100% financing, where the normal conventional ones don't do that. You've got to have down payment money. Okay.
In terms of down payment for each of the programs, for conventional, what's the minimum down payment for a conventional program?
So on conventional, as long as we meet all the other criteria, if you are a first-time home buyer, and so that means you haven't owned a home in the last 3 years, you could put as little as 3% down. Gotcha. The vanilla version for the rest of us is going to be a minimum of 5% down. Okay. And then on up to however much you want to put down. Okay. Now, anything less than 20% down is going to require what they call mortgage insurance.
Mm-hmm.
In the conventional side, that's private sector mortgage insurance.
Mm-hmm.
We shop for that through 4 or 5 different programs that are out there and available, to see what gets us the best bang for the buck for our customer.
Okay.
FHAs is 1 MI. Everybody gets the same.
Gotcha. Now, in terms of private mortgage insurance, they're going to take into account credit score and things like that with that too, aren't they?
And debt to income. Yep.
Okay.
Credit score, debt to income, and the down payment.
Gotcha. Okay. And at what point?
Based on risk.
Okay. What point will they, because sometimes, how they'll sometimes waive an appraisal.
Mm-hmm.
When does that kick in? Does somebody coming in with 20% down, will at that point, will they waive an appraisal and I'm talking conventional, not FHA and VA.
Well, we go in the back and we get the 8-ball out and we shake it. And that tells me, no, I'm kidding. There is no way to know or forecast if somebody will get what we call a PIW, a property inspection waiver.
Okay.
There is no way to know that. I have had some people that have put 50% down and still had to have.
Is that right?
It's all. Wow. So it's based on the databases for both Fannie and Freddie. This is conventional side only, right? Mm-hmm. Fannie and Freddie over decades have been collecting information on different properties as they get those loans.
Okay.
And they value that property information.
Okay.
As those homes buy and sell over the years, there are some kind of algorithm that they use to determine whether or not they think the value that you're paying through your purchase price is adequate enough for them to not need an appraisal, again, based on risk.
Gotcha.
So I've seen 10% down get property waivers.
Wow. Okay.
I've seen people 50% down still have to have one.
Wow.
So I've also seen where Fannie doesn't require a property or doesn't require an appraisal, but Freddie will. Well, I'm going to go with Fannie because it's going to save you $650.
Gotcha.
But we do tell our clients, hey, we have an opportunity to maybe not get an appraisal. And I have some folks that are like, no, I'd rather have that just for my own peace of mind. And that's okay too. We don't have to utilize that. It's just something that they'll offer occasionally.
Okay. Now, in the current environment, what are you seeing in terms of low appraisals? How often does that, how,
knock on wood. We have been blessed not to see a lot.
Okay.
I think this also matters when you partner with an agent like yourself who's going to go ahead and they're going to do their own judge of whether or not the property that you are helping someone buy commands that price. You're going to know in advance if it's over, if it's under, be nervous, talk about appraisal gaps, paying who's going to pay that. I have not seen a ton of them. Doesn't mean they don't exist.
Yeah.
It just means that agents and buyers are having very good conversations about, okay, they've got it listed here, but we need to be prepared. And how will we handle if our contract is accepted at $350, but it comes in at $340? What are we going to do?
Yeah.
But I don't see a ton of them right now.
Okay.
Doesn't mean they're not out there. Just I haven't had a lot of them.
Gotcha. Now, for an FHA or VA appraisal, you know how they have to be safe, sound, and secure. And they call out different things. What do you see from the loan side? What is kind of like the most standard thing where it's like, oh, there's that handrail again, or oh, it's peeling paint again? What do you see on your end?
That's it. The peeling paint.
Yeah.
Lead abatement if it's prior to 78. Chipped and peeling. That's a big one, like a shed out back.
I know. The shed.
Window sills that are that have been painted shut and need to be opened.
Yeah, they need to.
Any cracks over 2 inches in the sidewalk, trip hazards.
Yeah.
That's what I see is the cement work, the stoops, the handrails, anything that's a big safety issue. I did have one the other day where the appraiser did not like the deck. It moved slightly when they went up and down the steps.
Okay.
So they didn't ask for the deck to be replaced or any of that kind of craziness. They asked for it to be secured, which I don't know what they went out and did. I'm sure they, put some kind of,
there's those steps,
they are
can be
easy
kind of wobbly. You know what I mean?
Yeah, wobbly. So that was an easy fix and not very costly. But paint can be costly. It depends on how bad the paint is.
Right.
But again, they're looking for trip and safety issues.
Yeah.
That peeling paint, especially if there's a possibility there could be lead and you don't know if you've got little ones that are going to be around.
Right.
With that kind of thing. So I will say for some reason I've started to see a few radon inspections coming up, which for a long time I didn't. And now all of a sudden that's a thing again.
So if the radon test is on the purchase agreement, then they want to see the results of it. Is that what the situation is?
Keep that off there and handle that outside of our contract. Anything that's written on the contract becomes something that we have to address. And if it's a safety situation, that starts to get kind of important. So most of the time, things like that are not put on there, but they still surface occasionally.
And Clark has a question here. Can a person buy a second house with an FHA loan? No?
Nope.
Okay.
Has to be a primary residence.
Gotcha. Okay. And then let's see. MH08 says, who does loans for income property?
So we call those investment properties or rentals.
Okay.
That's what I consider an income property. I'm thinking that maybe that is what you're asking. Anyone that does conforming loans can do that. There's even some that are non-conforming, that you can get out there. But anyone that's really doing any kind of mortgage should have access to something, for an income loan, like a rental. What?
Say MH08 3 times. I'm gonna have to start doing that before the stream. MH08.
I'm not gonna try that.
I thought I was getting better. All right, that was the winning comment. I'm going to star that comment. Oh, that's funny. Now, let me ask you this. In terms of, for a while, they had a limit on the number of investment property loans. I think at one time there was 10, and then they went down to 4. Is it back up to 10?
As far as I know, it's 10 now.
Okay.
Let me put an asterisk next to that. That's mortgages.
Okay.
So you could have 20 rentals.
Okay.
But as long as you only had 10 mortgages.
Okay.
It's fine.
Yeah, that's
and there's a lot of ways to chop that up and try to figure it out. Sometimes we combined, and pay off one to free it up so we can buy another. And there's a lot of things you can do with that. Investment properties, when you purchase those, the loans out there need to be anywhere from 10% down if we can find an investor for it. But the flavor of the day is 20 to 25% down.
Gotcha. Yeah, I ran up against that. Was 10 was my limit, and 10 was also my mental limit before I would.
Sure. A lot of maintenance. It's a lot.
Yeah, that's like.
Yeah. Yeah.
But that was,
And,
I don't.
one of our folks here asked about the second home.
Mhm.
No, FHA doesn't allow you to do that. No, VA doesn't. It's got to be conventional. But the big trick with a second home is it's got to be over 50 miles from your house.
Okay.
So just keep that in mind, because I've had people, for instance, here, and I'm not really sure, I don't remember where you're located, but we could live out west, but we like to hang out downtown in a condo.
Right.
That doesn't work. So
Okay.
just be aware that there is a distance minimum when you do second homes.
Okay, gotcha. So you could, I mean, would you have to qualify? So if you wanted to live out west and have a condo downtown for whatever reason or whatnot, then that's going to be really hard
It'd be an investment property.
It'll be classified as investment property. Okay,
Yep.
so you got to be able to support
it can't
both.
be your second home because you're not living there and
Gotcha.
driving the required distance. Now, what I have had is people that live here and they buy and they want to have a lake house, 100 miles from here. That's
Right.
perfectly fine. We can
Okay,
make that
gotcha.
work. You've
Okay.
got to be over 50 miles.
Okay. Okay. I had another question.
Sorry.
No, what would you say are the biggest mistakes that you see people make during the loan process? We kind of touched on a few of them,
Mhm.
but anything that jump out that it's like people really want to avoid?
Yep. I would say changing those jobs intentionally,
Okay.
not the unintentional stuff. Okay. We can't forecast those things, but intentional movement. Talk to us about that. Let us decide together if the timing for that is going to work.
Okay.
Don't miss payments. Don't have oversights like that happen, because there can be last minute checks that we have to do, and then
Right.
those things come up. We
Gotcha.
don't want to see those and have to worry about addressing them with you.
Right.
I would say no big purchases. If the car breaks down, like I said, those are unforeseen things. We can't plan for that.
Mhm.
But again, we've got to have a talk about it, because now I need to know what that payment's going to be. Those would be the big things. I did have to have a young gal who went and bought $6,000 worth of new furniture and appliances. And we had to have mom come in and give her a gift to pay it off.
Gotcha.
Because her debt to income wouldn't hold that payment.
Okay. Okay.
Even though the payment wasn't going to start until after she closed, I
Right.
still had to deal with it because it was done.
Okay. Now, how often, with the market changing, because we're definitely seeing a changing in the market, how often now are you seeing seller concessions for like FHA and VA?
That's a really good question. I've started to see it a little bit more.
Mhm.
I wouldn't say that it's in the days of the buyer's market where it was on
Right.
every single contract.
Right.
But I'm starting to see a little bit here and there. And it's not a lot. It's usually around 3%, which in some cases is where it has to be.
Mhm.
But yeah, we're starting to see a little bit of it. Now, I couldn't tell you, David, if that was during multiple offers coming in, or if that was the only offer that came in and they were on that, and they're like, whatever we got to do. I don't know. But yeah, a little bit. I think
Okay.
it's worth asking.
Yeah.
On the advice of your agent.
Okay. And if somebody wants to reach out to you, how do they get a hold of you?
You know what? My cell phone is the best. I try to maintain that constantly. So the 402-618-6454 is my cell phone. We lend in 8 states. Me
Okay.
personally, I'm licensed in 8 states. So ask me. Got a lot of experience. My work partner also with me, Nikki, She has the same experience. We've probably got 60 years between the two of us.
That's a lot of loans. That's a lot of loans.
It's a lot of loans. It's a lot of loans. But you know what? You find something you like, you continue to do it, and we love it. So
exactly.
Happy to help answer questions and provide any guidance that we can.
All right. Any last questions in the chat before we let? I always want to say. Sometimes I want to say Elaine. It's Alana.
Okay. It's okay. Okay. No worries. I answer to many things.
All right. Clark says, great show tonight, David. Thanks for joining us tonight. Alana.
Thanks for having me. I would love to come back and talk more in depth, on anything you want.
And MH08 says, gives us a thumbs up.
3 times
All right. Well, I tell you what, I really appreciate you being on tonight's show and appreciate everybody in the chat. We got a lot of information. You answered a lot of questions, and I think people came away with a lot more value tonight. So that's great. Anything else you want to let us know, or anything else that we didn't cover that we should have covered?
I think it'd be worthy at some point if you want to have me come back and talk about maybe down payment assistance and the fact that it's still out there, and might be a fit for somebody that is limited on their cash supply, or maybe they know someone that is just starting out and needs some help with their process. So if that's something in the future you'd like me to get information on, I'd be happy to share that.
Awesome. Well, I really appreciate it. I want to respect your time tonight. Thanks again for being on the show, and we'll have you back. All right.
All right. Thanks so much.
Thanks again. You betcha. Bye-bye.
Take care. Bye.
All right, everybody. Well, I tell you what, I appreciate everybody stopping by tonight, and always great to see everybody. If you don't mind giving the stream a thumbs up, and if you're not, we just surpassed 5,000 subscribers. So I really want to appreciate everybody who subscribes to the channel. So I really appreciate that. And MH08, I'll see you next week. But I really appreciate everybody stopping by. It's always a lot of fun, and always appreciate the chat. So everybody, you guys have a great week, and we'll see you next time. Bye-bye.